We're going to begin by discussing costs. This is pretty similar to what we covered in chapter 18 when we discussed direct materials, direct labor, and factory overhead. Cost behavior is the study of how specific costs respond to changes in levels of business activity. Business activity can mean many things depending on the type of business. For example, it could be units produced in a manufacturing company. In a hotel, the business activity could be rooms occupied. For retail businesses, it could be the number of sales made. Here at OCC, our business activity could be classes taught or even students enrolled. CVP analysis is part of managerial accounting. The purpose is to help internal users make predictions and business decisions such as how many units must we sell to break even? How much does income increase if we install a new machine to reduce labor cost? What is the change in income if selling prices decline, yet sales volume increases? Or it could be vice versa. How will income change if we change the sales mix of our products or services? What sales volume is needed to earn a target income? And many other questions like this. We will begin by discussing the different types of costs. The first cost we're going to discuss is fixed costs. Fixed costs are costs that stay the same regardless of the business activity. That means no matter how slow or busy the company is, this expense would stay the same. That is why this graph shows a flat line. We will be using this graph throughout this chapter. The horizontal line at the bottom is the amount of units produced or whatever the business activity is. Producing units is just one example. The vertical line on the left-hand side is the cost of the expense. In this case, regardless of business activity, whether it's at zero or it's really high, the cost is going to stay the same. That's where the flat line comes into play. Now, the flat line is the total overall cost. If we break this down on a per unit basis, it will vary inversely with activity. A per unit basis means per business activity. I'll give you examples of how this works in a moment. Think of some examples of fixed costs you have. For example, my mortgage is a fixed cost. Regardless if I'm home every day or if I'm out on vacation for the whole month, I still have to pay the same amount of mortgage. Regardless if I use the house a lot or a little, it doesn't change. Overall, it's still fixed. Another example is my car insurance. I haven't driven at all in the past several weeks, yet I still have to pay the same amount of car insurance. For you, you might have a Netflix account. Regardless if you watch Netflix all day, every day, or you haven't looked at it once this month, you still have to make the same payment. These are fixed costs. Some examples of fixed costs that businesses have could be property taxes, insurance, rent, depreciation on buildings and equipment. These expenses that a business has would stay the same regardless if they had a lot of activity in the business or none at all. Regardless if it was a slow month or a busy month, this would stay the same. Let's look at an example for this. Let's say I pay rent of $1,000 per month for my facility. In my facility, I make shirts. If I made 0 shirts for the month, my cost would still be $1,000. Let's say I made 1,000 shirts. My cost would still be $1,000. That's why the line here is flat. It doesn't change regardless if I go up and up in the amount of units produced, that cost is flat. Now let's relate it to on a per unit basis. Let's say I only made 1 shirt for the whole month. I still had to pay the $1,000. How much of this $1,000 went to that shirt? Well, that shirt cost me $1,000 to make because that's what I had to pay for the rent. Let's say I made 1,000 shirts. How do I associate this cost with those 1,000 shirts? Well, if I made 1,000 shirts and rent cost me $1,000, then I can allocate that by saying it cost me $1 to make each shirt. That's why on a per unit basis, it's more of a curved line. The more we make, the more of the cost we can allocate. When we're looking at these graphs, we're always looking at what's called the relevant range. This is the range of activity over which a company expects to operate during a year. We're usually looking at a relevant range of maybe 40 to 80% capacity. If it goes below 40, then we might start laying people off, or if it goes too high, we might have to start to build more facilities or open up more locations. So we're really looking at this like optimal range right in the middle. The next type of cost we're going to talk about is variable costs. Variable costs are the exact opposite of fixed costs. These costs do vary in regards to business activity. This means the more our business activity increases, the more the cost will also increase. It will also increase proportionately. That's a key word here. Using the same example of making shirts, let's say we were able to double the amount of shirts to be produced. What costs will also double? Our direct materials would double because we now need 2 times the amount of fabric. Our direct labor will also double because we need to pay employees to produce twice the amount of shirts. These are all variable costs. One of your variable costs could be gas. The more you drive, the more gas you spend. And on a side note, we're only looking at how cost responds to activity levels, not outside factors. Obviously, gas prices change every day, but that's not because of us. That has to do with the outside factors and economic activities. But if I double the amount of miles I drive, I will also double the amount of gas I spend. On a per unit basis, these costs stay the same. Once again, we're not looking at outside factors. We are doing this for a specific point in time. If gas costs $2 a gallon, then regardless of how many miles I drive, each gallon of gas will still cost me $2. If I'm making shirts, my overall cost will increase, but each shirt itself will cost the same amount to make. On a per unit basis, it'll be the same. I still spend the same amount of labor and the same amount of material on each shirt. Regardless if I make 1 shirt or 1,000 shirts, I'm still spending the same amount on each shirt individually. Overall, the more I make, the more these costs will go up. Our final cost is a mixed cost. And you guessed it, it's a combination of both fixed and variable costs. One example I always like to use is renting a U-Haul. For anyone that has ever rented one, you know that you are charged a flat rental rate plus a per mile rate. The flat rate, you would be charged regardless of how many miles you drive. Therefore, that would be a fixed cost. You're also being charged per mile. The more miles you drive, the more this expense will increase. This would be the variable portion. You are charged one fee, which is the mixed cost, a combination of the two. One example that businesses have a lot of, and you also personally, would be utilities. Your electricity bill, your gas bill, heat bill. You're usually charged a flat service rate just for having the service with them, plus your usage is added on top of that. Your flat service fee would be the fixed cost. Then the more you use it, the higher that goes. That would be your variable cost. You're charged one cost, which is the mixed cost. You'll know it's a mixed cost because the cost will increase with business activity, but not proportionally like variable costs. When companies do have a mixed cost, they will need to determine what part is fixed and which part is variable. This is because when we do our analysis, we need to know those two amounts and group all the fixed together and group all of the variable costs together. In order to separate and mix costs, we will use the high-low method, which we'll be discussing soon. This graph shows the straight line as the fixed cost, and the variable cost gets added on top of that. The total would be the mixed cost, which would be the fixed cost plus the variable portion will give us the total cost. And like I said, we'll be using the high-low method to figure out the variable amount and to figure out what the fixed amount is. Okay, we're now going to discuss the high-low method. As a reminder, the high-low method is used for mixed costs. We will use this method to separate the mixed cost into its fixed amount and variable amount. We will use information from the highest and or the lowest levels of activity to determine this. The first step is to determine the variable cost per unit. We will have several months worth of information. We will know the business activity levels and the total mixed costs. To find this number, we will follow this formula. We will look through the data and find the time periods with the highest cost and activity and the time periods with the lowest cost and activity. We will take the highest mixed cost and subtract the lowest mixed cost from it. We will then take the highest level of business activity and subtract the lowest level of business activity. We will then divide both these numbers. To reiterate, it's the highest minus the lowest cost divided by the highest minus lowest activity level. Step 2 is to determine the total fixed costs. The formula for this is a little bit more complicated than from step 1. You can use either the highest numbers or the lowest numbers. However, my advice is to do both. You will get the same answer for both of them. And if your answers do match for both, then you know you did it correctly. To use this formula, you either take the highest or the lowest cost, then subtract the multiplication of the variable cost per unit times either the highest or lowest activity level. The variable cost per unit is the answer you got from step 1.